Welcome to Investors Insight, where today's topic is watching spikes carefully. So a lot going on this week, a lot to talk about today. Trey is going to talk about spiking interest rates, which is causing a lot of volatility. Ty is going to talk about some historical relevance of pre-election years. But first, there is a lot going on this week, and one report we'll be watching carefully is the GDP report for the third quarter that comes out on Thursday. And so we're expecting GDP to come in north of 4%, which will show the economy is growing at a strong rate. And keep in mind that many economists were actually calling for a recession this year, earlier in the year. And so the report on Thursday could say the opposite. The economy is still growing. And one reason the economy is still growing and it's strong is due to consumer spending, which makes up close to 70% of GDP. So you can see in this first chart, consumer spending on retail and food continues to be really strong. As this chart goes back all the way to 2013, you can see that it's spiked a lot since 2013, and it's proof that we're still seeing a strong job market and higher wages. So while we're enjoying a strong consumer in the economy, we're also watching the price of oil spike and watching this carefully because rising prices due to the conflict in Israel and the Middle East, and we're watching oil carefully because, as you can see in this chart, spikes in oil have led to previous recessions. And you can see the shaded columns that show previous recessions, and most of them were preceded by a spike in oil. And so the combination of higher rates in oil are a threat to the strong economic growth that the GDP report will show on Thursday of this week. As always, we're analyzing the good and analyzing the bad. So Trey, talk about the spike in interest rates, because that's obviously leading to a lot of market volatility in the equity and the bond market. Talk about that.
Yeah, absolutely. Thanks very much, Bobby. So the recent spike in interest rates seems to have caught Wall Street on the off sides, and we've seen the market react very negatively. The equity market react very negatively, along with the bond market, because of that surprise. You can see here on these two charts, I've got side by side the 10-year Treasury yield and the 30-year Treasury yield. And the recent movement, while very steep, kind of still goes in line. You look back over 2022, we've been seeing these interest rates move higher. But looking at this next chart, you'll see why Wall Street was caught off guard. This is Bloomberg did a survey of 50 economists and their forecast of where interest rates will go. And the most recent survey they did still had zero economists projecting that the 10-year Treasury yield would hit 5%. The 10-year Treasury yield hit 5% last week. And economists still don't expect it to be there. So it shows how offsides the average U.S. economist was on Wall Street, with the end of year forecast for 10-year Treasury being 4.6. That's 40 basis points below where we currently are. And so what has that done? That has caused the bond market and the stock market to sell off. I want to show this chart. It's got three lines. The purple line is TLT, which is an ETF that tracks the Treasury bond market 20 years and out. So it's a good representation of what's going on in long-term bonds. The orange line here is the S&P 500, and the blue line is 1-month Treasuries, so short-term bonds. And so it's not the total market that's falling off; it's the long end because of the surprise. And also, I like this because it puts into context that while yes, we've been talking over the last few weeks about how weak September was and how the stock market is kind of limping into the end of the year, the bond market is doing twice as bad as the stock market. So something to remember. This is why we're such big fans of active management, being proactive, and not just stocks, but also bonds, because there is the ability that you don't have to be all the way across the curve. You don't have to take that much risk in the bond market, which is now being heavily punished by the stock market and investors overall. But then where is these higher interest rates are also bleeding through to the consumer that you were just talking about, Bobby. The next two charts I want to show, the first one is the percentage of new car buyers that are paying over $1,000 a month for their new car hit 18% recently. That's well off recent lows of zero as recently as 2020. And then the next chart's it goes back further. Going back to 1986, we are now at record low affordability for housing. So the U.S. consumer is less and less able to afford houses at higher interest rates. 30-year mortgage rate hit 8% last week. So we're watching this very closely because it's impacting stock market, impacting bond market, and it's really going to start impacting the consumer that has been really the bellwether of this economy that has seemed to not really notice the higher interest rates. So if something we're watching closely, we may be at this tipping point where higher interest rates are actually finally building through. People say that rate policy by the Fed has long and variable lags. We may be hitting that point where the variable lag may be finally having some impact. So something we're going to be watching closely going forward.
Yeah, thanks, Trey. The Fed meets in a couple weeks, so all eyes on what they will decide to do. So, and we'll keep you updated before that. And then Ty, our viewers know that we like to look at historical relevance of markets and certain events. Talk about what you were able to find in pre-election years.
Yeah, thanks, Bobby. And so I'll kind of start with where we are today. The market, of course, over the last couple of months, has been a little different feel as opposed to the rest of the year here. We finally got the volatility index, or the VIX, to spike over 20, which means it's also referred to as the fear gauge. And then we have about 35% of stocks in the S&P 500 above their 200-day moving average right now, which is the lowest reading since November 3rd of last year. So we're starting to finally get to, hopefully that kind of oversold level. And then some historical relevance for that. For the past 10 pre-election years, we have seen on average the S&P bottom on October 19th. So here we are on October 23rd. And as you can see in this chart, right there around October 19th, give or take, just a few days there, we see that the market bottoms here. We are, of course, in a pre-election year. And so, let's kind of see where we go from here. Of course, history doesn't, lead to future results. Nothing's guaranteed here. But it is an interesting stat that I thought was really time relevant here as we sit at the end of October.
Yeah, so we're analyzing the spike in GDP that's higher, which is a good thing, versus the spikes in rates and oil, which is not such a good thing. So a lot to analyze here in an important week. Looking forward to seeing the GDP report on Thursday. So a lot going on. If you have any questions about anything we've discussed, please reach out. We'd love to hear from you. And so have a great week. Thanks.